Welcome, and thanks for joining me today on Mortgage Manager Playbook, a podcast for sales leaders who want to improve their team's sales performance and originate more loans. I'm Pat Sherlock, your host. Today we're going to do a deeper dive on the steps to pricing a loan. It's such a basic but also a somewhat complex issue, and I have the perfect person to share his wisdom on this, and that's Jeff Scheuren. Jeff is EVP and President and CEO of Fulton Mortgage Company. So Jeff, I'm thrilled to have you today because this is something you do a great job explaining.
Thanks, Pat. Happy to be here.
Well, let's talk about the basis. And I think just a few minutes ago, you were talking about the loan officers on the street. They don't understand this issue of how can somebody be lower? How can they lose a loan? How all of that works. So I thought it would be important to kind of look at it from the big picture and talk about the framework. And the framework is, in other words, the cost of funds play into it. But let's talk about putting on your secondary mortgage market hat. What are the first things you look at to establish the base level? And then we'll go into the margin side and all that.
Yeah, well, so it certainly starts with the cost to originate, right? So, and that's unique per lender, but on average, it's been going up year over year. To make a profit, you obviously need to price enough to cover those costs. So understanding your costs, both on the operation side and the sales side, are critical.
And so once you have established that, and you're exactly right, although the MBA, I think, was saying in the recent reports that it's 13,000 per loan. And of course, that's an average component. And so some lenders are lower, some lenders are higher. And then what ties into it, 50% of it is sales compensation. And so that depends basically on each lender. And so when we look at those costs, what's the next step that you do? And what's the impact of looking at the market and the 10-year treasury and all of that?
Yeah, so once we understand what our costs are, we understand base competitive, what we're competing against, we do look at, where our secondary marketing takeouts are pricing. So looking at it from a best execution perspective, you have the GSEs, and then you have your private investors and your aggregators. So depending on your strategy, if you're going to retain servicing or release servicing, it really comes down to who is the best price on the street, and can you price through modeling that you're offering the best rate that you possibly can from any different lender that is offering the best pricing to you while still trying to maintain that profitability.
And so when you're looking at, and again, we just briefly talked about the difference between an independent mortgage banker and a depository, and that impact of essentially the famous free money of whatever the depository has for the checking accounts and all of that. Talk about how that in plays with it.
So on the source of funds?
Yeah, on the source of funds, right.
Yeah, so from a depository standpoint, we're not dependent on warehouse lines. So our cost to carry may differ from an independent mortgage bank. So that certainly plays into pricing analytics. How long are you going to hold that loan once it closes to before you deliver it on the secondary market? So all of those, every component of income is considered on where your margins need to be. So you have your fee income, you have your interest income, and then you've got your gain on sale margins. So all those contribute to your profitability. And if you are making a little bit more on your interest spread, you might be able to be a little more aggressive on your pricing margins.
And so when you're talking about the margins, maybe you can elaborate a little bit about that, the functions that go into that, because in essence, it's another way of saying that this is what we have to make in order to make money. But talk a little bit about that and how that is impacted certainly at each institution.
Yeah, so the secondary marketing execution, it starts with that, right? So what
Sure.
that we can get from an MBS if we're delivering into a security, what
Hmm.
we get from Fannie Mae or Freddie Mac through their cash window, or from an aggregator. So what are we earning on that loan, and then adding a margin on top of that
Hmm.
to establish the rate to the customer. So there's a primary rate and the secondary rate, and the spread between those is
Is
the
your margin.
pricing margin.
And so this is something, and Chris, I know you and I go back a little bit. And so, I mean, in the days where obviously daily events can make a big difference and people will price accordingly, but there were times where people would price once a week. And it's almost something like you can't believe that that would be that they would do that, the old
Yeah,
days.
Yeah, so those days I think are long gone. So intraday volatility certainly plays a part. Reprices can happen,
Hmm.
pretty quickly, depending on reactions in the market to certain economic indicators or events happening. I know just this morning, the day was kind of expected to be a fairly easy day in the mortgage market. And then, an economic indicator release came out, and all of a sudden mortgage-backed securities were off, almost 3/8 of a point. So anybody who had established pricing right before that indicator came out may now be priced higher than they should be. So they might reprice.
Right. And so typically, again, are you repricing several times a day or do you typically just do it once a day?
Well, you hope to only do it once a day, but
But right.
yeah, intraday would be if there's a major market movement, and depending on every lender's own, what's the word I'm looking for?
The dynamics within their company. In other words, what is it that,
The
unless,
threshold. So they may have a pre-established threshold. Say if market moves a quarter or
right.
3/8, we pull the trigger and reprice.
Right, right. And then of course you're also looking when you're talking about best execution, talk a little bit about that versus the level of lenders. Certainly some people aren't doing best execution, others are not. They're doing best efforts and talk about
Mhm.
the difference between what that all means and it translates back into the pricing.
Yeah, so there's definitely advantages to pricing one way versus the other. So a lender who is pricing best effort, whereas they're taking an aggregator's rate sheet, adding a margin to it, and then as loans come into their lock desk, they're turning around and locking those directly with an aggregator to make the best efforts to deliver that loan should it close. Whereas someone that may be hedging their pipelines can price to a multiple number of investors that could all easily buy that same loan. And then you determine who's going to buy that loan once the loan closes, whoever is the best price at that time. So depending on the given investor's appetite, their pricing may change. So certainly advantage to being able to have multiple investors at any given time for conventional business, government business, whatever you're delivering, so that you're not beholden to necessarily one investor.
Right. And so talk about the decision process. And then obviously the secondary mortgage department is maintaining the information. And is this, talk about kind of how you've seen it play the best, where it's a corporate decision within a company to make a decision on what is the set profitability they want to make or margin, and do we want to maybe on selective basis make some adjustments. Talk about that framework and what do you go through thinking? Do you do it down at the loan officer level? If you see somebody that keeps generating early payment defaults, do you price differently? Talk about how that kind of, from your viewpoint.
Yeah, so I've seen it many different ways, but so I personally look at everything at an aggregate level, right? From
Sure.
the So we know we want to make X amount on production. So you may make less margin on a particular conventional product versus, say, a government product. So you certainly see some cross subsidization, if you will, right? So you're making less in one product, more in the other, but in the aggregate, you're making your target. So, and you can drill down pretty well into different dynamics there based on regions, based on sales managers, based on
Hmm.
overall performance, pull through rates, and if you're in more than just a retail channel, it certainly comes into play.
Talk about the pull-through rate. I'm glad you mentioned that because I don't know that people recognize the importance of it.
Yeah, yeah. So obviously, customers, not everyone that applies with you, locks with you, is going to close. So the pull through rate is how many of those applications locks actually close that can be delivered to the secondary market. Now, if you're doing best effort, like we were just talking about, there's very
Hmm.
little risk because if it falls out of your pipeline, that's it. You're done with that transaction. But if you're hedging, then you've still got risk because you're
Hmm.
hedging on until it's able to be delivered to the market.
And so okay, and on the pull-through side, in other words, the amount that is actually delivered does matter. So,
It does.
uh, some people somehow think it doesn't, but talk to me about that. And do you see differences between pull-through rates based on the better originators have high pull-through rates and other originators don't?
Yeah, I mean, you certainly it varies, right? You can see differences depending on a type of
Hmm.
originator. And that's not necessarily just the type of the originator, but also the type of products being originated by that originator. So you could see pull through performance different on a jumbo loan versus a conventional loan or a government
Mm-hmm.
loan. So that plays into it. And the less loans that pull through as a company,
Mm-hmm.
or as a sales manager or a loan officer, your costs go up because even though once they apply, you start seeing cost on that loan, right? From the credit
Right.
report, the pre-qualification and ordering appraisals, soft costs on
Mm-hmm.
work time involved in processing the loan until it is withdrawn, canceled, or denied. There's a cost of doing business for that percentage of loans that did not pull through.
Right. And I don't know that people recognize that there is that's involved, which leads to the big question and part of what we were talking about also today. And so when lenders make this choice to, in other words, they can decide to do less margin or whatever just to stay competitive. Have you seen that strategy? I mean, you see that strategy every day, but in the long term, have you seen that really make any sense? At some point, it doesn't.
It certainly does not. It doesn't make sense to me. I don't. That's definitely not a good long-term strategy.
Right.
It could be, a short-term strategy, thinking depending on positioning or recruitment or a need to retain. Yeah, I mean, when you look at the MBA performance report from 2023, the majority of lenders, on average, lost money on every loan closed.
Right.
It's unsustainable, right? So, at some point, either margins have to go up or costs have to go down, one or the other.
Right. And so that does lead to the question, when you're seeing, and of course you've done this for a long time, when you see people basically price unrealistically, in other words, that they don't really they're in essence loss leaders in a way.
Yeah.
And so invariably, in my experience, they invariably they're trying to cover another problem. And so therefore it cannot last long. And so I think loan officers maybe don't really understand that just because this particular lender, ABC lender, is really pricing below market, that doesn't sustain itself. And of course, they don't last forever is what ends up happening. But usually it's a sign, in my experience, that there's troubles at the lender when they really are way off versus their competition.
Yeah, I agree. I think maybe not in all cases, but it's certainly a
Hmm.
red flag. Said I would be wary of it if I was in that situation. We don't like losing loans, but we aren't going to originate. We're not going to pay to originate a loan. It's just not our philosophy, right? So
Hmm.
we said no to loans and concessions because it just doesn't make sense for us, and that's painful in the short term, right? Certainly, empathetic to every loan officer that is struggling right now. Right? Like I said, every loan counts, and when you've got opportunity and you lose it because somebody's undercutting you, it's painful. But being disciplined and thinking about the long-term strategy is best for the company and it's best for the sales.
Hmm. Right. And that leads to the issue. And I think that when it comes to the famous point, let's assume we get to an application, it's time to float and lock those discussions. How do you see it handled best? And I see mostly that loan officers don't really know how to conduct that conversation.
I've found that the more informed loan officers are of current trends and things that are impactful to pricing, like say
Mhm.
non-farm payroll numbers. There's
Yes.
things that are big market movers. Tend to do better in having those conversations. So either subscribing to a service, we offer some services to our loan officers to help them in those conversations. Right. So be as informed as you can, but never make a decision for a customer, right? Always leave it up to them, guide them and say, if they ask you, what would you do? And say, this is not my decision, it's yours. You don't want to be blamed if it goes the other way.
Right. And obviously it is the customer's decision, but you're there to guide, but that doesn't mean you just abdicate your guiding.
Right.
That's not a good thing. And so it doesn't get repeat business either. And so when you had to talk about, in other words, how to keep loan officers up to speed, what are the types of things that you would recommend that the loan officer is doing on a daily basis to keep up with market trends?
So there's services out there that can provide really good
Hmm.
intel on what's happening on a daily basis. They can provide commentary in the moment, pricing detail like market movement. without costing a lot of money. I would certainly make sure if I'm a loan officer on the street, I would want to subscribe to as much of that as I could and pay attention to it, right? And really drill into it so that when a customer comes to me that I can have that conversation about, well, why did the market react that way? And why are rates up? And what can I expect if I don't lock? You
Right.
can have conversations. You're not making a decision, but you can say, well, here, what could happen if you don't lock, right? Rates could go either way, but they could be impacted negatively if this happens. That information, that those subscriptions will arm you with that kind of information.
Right. But then it also leads to the issue, not just on the consumer side, but certainly what I see, and one of the things that I train on is to make sure that loan officers also are explaining to the realtor world how the market works, because this issue isn't really well understood by them either. And so no surprise that all they talk about are basically, it leads to negative conversations about race when in fact it's obviously a much more complex topic than that. So what do you see loan officers do a good job with educating the realtors on this topic?
Some, not everyone, no, not
Sure.
all, but most, and the ones that are looking at that type of information and taking it in are having those same conversations with realtors that they are with
Right.
the bar.
So if you were going to say, I mean, I'm a big fan of following the 10-year. And
Mhm.
so what would you say to a loan officer, what should they follow that they can get off CNBC or whatever it is besides doing these paying services that you're talking about?
Yeah, so the 10-year is a good proxy. It certainly is the benchmark to a 30-year fixed rate mortgage. It's not a perfect correlation.
Right.
So, it's not going to, if the 10-year moves an eighth in rate, doesn't mean or a mortgage rate's going to move an eighth in rate, but it's going to be closely correlated. So you following the 10-year will serve you well.
And so, is there any other benchmarks that you really follow? I mean, for let's say the person who doesn't want to go and buy the services. I mean, I'm a big Rob Christman fan, and I'm certainly a big fan of Bloomberg and all those other folks. Any that you particularly follow?
Yeah, I'm a subscriber, so I subscribe to as many services as I can.
Yeah, well, that's smart to do it. And I think as you get more mature into the world of being an originator, it is in your interest to be able to be knowledgeable on this topic. I do think it's a competitive edge. And what's the part that you think that loan officers really don't understand since you've dealt with them for many years? In other words, about this whole market of what the secondary mortgage market department's doing?
Yes, I think the biggest challenge we see, or in my career that I've faced, is not necessarily pricing in general, even though that can be a challenge. It really is not understanding the impact, say, if rates fell, and why can't we just reprice our entire pipeline, right, and give the customer the lower rate? It's a huge problem, right? So it's being an advocate for your customer. I can understand that, but also being an advocate for the company, right? So there's an agreement to lock in an interest rate made by the lender and the customer, and we want both to honor that. So certainly having an understanding of the impacts of rate movements to the profitability of a company goes a long way too.
Yeah, I can't recommend that enough, but I have to say frankly, and that's why I'm speaking to you. I'm saying frankly that I don't see a lot of understanding and it doesn't seem to get to the field. And I find how can you be a financial advisor without understanding your raw issue, which is obviously money. And it is
Yeah.
interesting. Talk about concessions. This is one of my favorite topics because I think people don't understand oh, well, I'll just do a pricing concession. Wait a minute here. So, I mean, I'm sure you get them every day, right?
We do, for sure. Yeah, pricing concessions they're I don't want to say they're tricky, but there is certainly regulatory constraints around what you can and can't do, right? So, from a fair lending perspective, when a concession request comes in, we 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 require documentation, right?
Hmm.
So, make sure that a rate request or concession request we're getting is warranted and is backed by an official quote that somebody received from a lender. Concessions just because of a relationship, or concessions just because we want to make it for this customer.
Right.
It's not something we can or advocate to do. We need to treat all of our customers the same and fairly. So, it becomes a pain point when we ask for that information, but it it's certainly something we have to do from a regulatory standpoint.
But also from the standpoint, concessions, in my view, should have been termed something else because they're basically kind of mini losses, is what they
Yeah,
are. And
absolutely.
I don't know that it's conveyed. And certainly, I will see lenders will track the information, but I don't necessarily see that it goes back to the actual loan officer. I mean, they talk about it, but not in actuality. Is that what you see?
Well, we track it, so we have
Hmm.
reporting on
Right,
at the aggregate level and drill down to the loan officer level. And concessions play a part in the pricing margin, right? So
right.
if concessions on aggregate are costing X basis points, you really need to add it back into the pricing
Right. So are you going down from the pricing level down to basically an originator level too? That's obviously how you're handling it.
absolutely. Yeah.
Yeah, which is smart. So, and so I want to, I mean, we could go on for this for a while, but I do want to talk about a couple of things that you think managers should do to make sure there's better understanding about this whole really core part of our business, which is understanding the capital market side of our business. So, what do you think managers should do? And then also, what is your recommendation for loan officers so they can be knowledgeable financial advisors?
Yeah, so from a sales manager perspective, is casting that right shadow. It's doing what you're expecting your salespeople to do, right? What your loan officers to do.
Hmm.
So you know, be as knowledgeable as you expect them to be, and be in tuned, and have a relationship with the secondary marketing manager and the secondary marketing department, and understand. I mean, I think we have a good relationship, a healthy relationship between our secondary marketing and our loan officers. And when we have regional sales meetings and regular calls, secondary marketing is part of that.
Hmm.
And our director of secondary often gives presentations to sales managers and loan officers to inform
Right.
them basics and of this is what we're doing, and so they can understand and feel comfortable that they know enough that understand why we're doing what we're doing. And he does really get into the mechanics of hedging and secondary at a level that they can understand, not technical. It's good enough, and it serves everybody well.
Which is smart because otherwise it's looked at as some group that nobody understands what they're doing.
Yeah.
So, but on the loan officer side, let's flip it to the other side. We kind of talked briefly, but how to make a loan officer, a financial advisor, has to be an understanding of the capital market side of our business. I don't know how you can skip this. Any other suggestions besides resources and anything else that you would suggest that they would do?
Yeah, be an advocate for your customer on the right products, right? So not just how does pricing work on a 30-year fixed rate versus a 15-year fixed rate,
Hmm.
uh, but adjustable rate mortgages, buy downs. What are all the options that are out there for a customer? Understanding what that customer's their their specific needs are, duration in the house, how long they
Hmm.
plan on living there, and what is their expected lifestyle changes maybe down the road, to put them in a product that's appropriate for them. Being able to show them and educate them on why here's all the information so you can make an informed decision, side by side, and in
Hmm.
a way that they can easily visualize it and understand it. It really creates that trusted advisor type relationship.
Well, I can't agree with you more, and we could go on forever, but certainly anything else that you would like to have as takeaways for today? This whole part of it's a core part of our business, and I'm so thrilled that you were able to share your thoughts on it because it's all understandable, but it does seem to be a mystery to a lot of mortgage people.
Yeah, and because it can be very technical, right?
Sure.
Between sector marketing and hedging and
Hmm.
everything that can be involved in the process. But when you break it down into its components, it's pretty basic. It's start with a price wholesale level, right?
Hmm.
Technically speaking, from the secondary market, we mark up for a margin that we want to make, and that's the customer's rate.
Simple, but not that simple, right? So,
Right.
right. Well, Jeff, I want to thank you for sharing your wisdom, and highly suggest anyone that's listening today that they reach out to Jeff. He's a great expert in our business, and certainly a well known and respected for his insights. So, thanks so much, Jeff.
You're welcome. Anytime, Pat. Appreciate it.
And thanks so much for everyone listening today. If you would like to subscribe, go to thepatsherlock.com. Thanks so much. Bye bye. Thanks for listening to Mortgage Manager Playbook. You can catch up on all our episodes by subscribing to receive each week a new show. Don't forget to share this podcast with your friends and team members. If you're looking to increase production, call me to discuss my prospecting sales training program, Ramping Up Realtor Referral Sources. Check out my website, www.patsherlock.com.